All right, that's me. Can I confirm I'm clearly audible?
Yes.
Great. Beginning in 3, 2, 1. The problem with QE and extremely low interest rates is that it's created an environment in which money is too cheap and has left the financial system relying on capital created by central banks. If we allow this to escalate, the eventual deleveraging in an environment where too much conjured capital exists and too much lending that happens on either side threatens financial calamity. 3 claims from opening government. Firstly, raising interest rates and investor confidence in the pound. Secondly, why clamping down on the amount of conjured capital in the English economy is vital. Thirdly, why we get better spending and investment in the long term. In terms of what this policy looks like, we think what this is likely to look like is action by the Bank of England, largely analogous to the monetary tightening that the Fed has done over the past few months in the United States. What this looks like ending the purchase of Corona bonds under the pandemic's emergency response program, which converts those bonds into electronic capital that is then injected into the economy via the central bank through quantitative easing. It looks like raising interest rates back to the 2% threshold over the period of the next few years. Crucially, we think we can do this in a manner that minimizes the immediate shock to markets at the point at which the Bank of England announces this. We think that given that the Fed has already done this and the ECB is contemplating doing this, investors are already likely wary and therefore have likely already preemptively sold some assets. Therefore, the shock is unlikely to be a massive disruption. But furthermore, we think it likely looks like an announcement a month prior, followed by a tapering that is gradual, but still far more significant than what op can likely defend, which is likely maybe a gradual monetary tightening over a very long period of time. I think the best op line in this debate is what this fear will do to the money supply in terms of tightening and might cause significant problems because it will scare off investors. Why is this not a problem? Firstly, even if it is the case that investors are scared by potential volatility in the market, we would rather bite the short-run economic harm specifically to investment in England in order to stave off persistent hyperinflation and huge catastrophes within the developing world. Secondly, we're fine with spending less in the short term because a reduction in the money supply, even if it is the case it induces an endogenous economic shock, reduces the devaluation of the currency in the long term and increases the degree to which investors are likely to save rather than spend. At the point at which you are spending less, this cools off the economy because there's less money being circulated, which strengthens the purchasing power of each individual pound. This is a crucial way to tamp down on the current situation where hyperinflation is particularly high. This is the mechanism by which we reduce recessions. The second up line in this debate is that this might all be due to exogenous economic shocks, and therefore, plausibly, this might have less of an effect than it otherwise may. Firstly, this is empirically incorrect insofar as inflation was already rising fairly rapidly prior to COVID. The reason it was doing so was because central banks in the response to 2008 pumped thousands of pounds and dollars into the financial system in order to prop it up. And secondly, even if it is the case that there are exogenous factors contributing to the inflation, higher inflation, which this policy reduces insofar as the inflation is not due to exogenous shocks, makes it significantly harder to weather the exogenous economic shocks like supply chain issues. Because at the point at which a currency becomes devalued, which makes it harder to pay down debt, what this does is it makes the Bank of England have a significantly more difficult time paying down debt in foreign currencies at the point at which the pound is significantly devalued due to inflation. What this does is it gives us a mechanism by which we can tamp down on inflation before things get too bad, before these investors call in their debts, before the Bank of England is really in trouble. Why are raising interest rates now good? This is the first claim. The Bank of England needs to raise interest rates in order to increase investor confidence in the immediate term. The reason why this is true is because markets are already shaky. The Fed has already done this, and there are significant calls from ECB officials to do the same. At the point at which the Bank of England announces a tightening, this mitigates the fear that investors feel of a potential much more sudden future tightening in response to an immediate crisis. Note that there are multiple crises investors are concerned with on the horizon now. This is not some speculative future harm. That is another wave of COVID due to a variant. That is another supply chain shock due to China shutting its borders. That is potential further economic shocks due to companies pulling out of areas that are stricken by structural unemployment due to the long-term nature of the COVID crisis and concentration of capital in urban areas at the expense of rural ones. When you do this now, before inflation becomes a persistent problem, it mitigates the degree of harm due to economic shock because the cool-off happens faster. This is crucial because opposition cannot get away from an eventual tightening being a necessity, because at the point at which you have a financial crisis, it is likely you have to stop lending in order to not induce calamity due to over-leveraging. We cool that off. It is important for a couple of reasons. Firstly, it increases investor confidence in the English economy, which means you get a broader tax base, which means people are better off, which allows individuals to save more and weather the potential future economic shocks. But secondly, it's important because the pound is often a hedge against the dollar on international markets. If the pound becomes significantly devalued, but the dollar comparatively does not, because the Fed has enacted this monetary tightening, but the Bank of England has not, more people buy the dollar at the expense of the pound. That is, investors holding the pound as a hedge against the dollar sell that and buy dollars on international markets. The reason why this is bad is because the rising value of the dollar makes it very hard for developing nations, which take out loans in US dollars because it is reserve currency and their own currencies are looked at as unstable to pay back their debt. This is crucial because massive amounts of developing nations around the world are in debt to the US dollar. When the dollar raises significantly in price, it makes it significantly harder for those developing nations to pay back their debt, which makes it significantly less likely that, one, they're able to spend on things that benefit their own economy, but two, when another exogenous economic shock hits them, they are in significant trouble. The second claim I want to make in this debate then is why QE has massively distorted the economy and ending it is good. Since the 2008 crisis, the Bank of England has pumped money into private banks through an unconventional monetary policy process by which they print electronic money and then inject it into banks and financial markets in return for purchasing bonds and securities. What this has done is it's lifted the money supply within the financial system, reduced interest rates, that is the cost of borrowing money, disproportionately in favor of bigger banks and corporations. What this has done is it's created an environment for speculation because all of these banks and financial institutions have tons of cheap capital to lend, and then when they lend it, it causes problems. What does it do? Firstly, it benefits big banks because it allows them to sell assets to the central bank in exchange for more liquid forms of capital. Their books appear more liquid, but they exchange less liquid assets for cash. What this they then do is they buy their own shares to artificially drive up their value and increase their speculation in derivatives and other complex and risky assets. The low interest rate environment generated by QE made it very easy for these banks to borrow money cheaply, increasing investment spending. The problem is that given they cannot receive a good return in a low interest rate environment on low interest investments, they have to move their money into higher yield and higher risk class assets like CDOs or mortgage-backed securities. This spikes asset prices and fuels asset bubbles in the economy. Before I explain the second problematic impact, closing.
So this is logical to do if the economy has overgrown very, very fast. Has the economy overgrown very, very fast?
Yes, it's happening empirically quite quickly right now, and inflation is rising rapidly. Therefore, we need to tamp down. Moving on. Given that this is the case, once you get these asset bubbles, what this does is at the point at which you have an economic shock, like the COVID crisis, like another variant, like a supply chain crisis, you have large numbers of corporations that are over leveraged because not only have they increased their speculation in derivatives and risky financial assets that at the point at which the real economy goes under, those risky financial assets become completely moot. They also lend to their main corporate clients cheap money with which these corporate clients buy back their own shares. What that does is it artificially drives up the price of stock on speculation, and they do things like executive compensation as well. What this has done is it's meant that these large corporations, in order to chase these high yield investments in these corporate stock buybacks, have significantly over leveraged. So not only has this created asset bubbles, slowed economic growth overall because they lend less to small and mid-sized businesses and lend more to large corporate clients. When the recession comes and when the economic harm comes, these companies cannot pay down that debt. What this means is you get a slower recovery from the next recession because one, you get a lack of investment in small businesses because the low interest rate environment induces lending to large corporations rather than small ones. But when the next economic shock comes, these large corporations are unable to pay back their debt, which means you are forced to inject more money into the economy, which increases inflation further. This creates a persistent inflationary spiral that leads to things like the 1970s in the United States. We think that's very bad to create, and we want to preempt that at all costs. Very proud to win from opening government.
All right, great. I would like to thank the Prime Minister for their speech. I would now like to invite the Leader of Opposition to deliver their speech. Hear, hear.
Starting. Okay. Starting in 3, 2, 1. Look, Panovka, Rumen Marinov is at best the 7th best debater in Bulgaria, maybe on a good day, right? He's a promising novice, but not that good. However, he's right when he asked this POI to opening government. Why should we do this now? We can do this later, right? When the economy is better off. Why must we do this now when the economy isn't that well off? We will fill this gap and basically, explain why it is vitally important we need to do this now. But firstly, and a very important piece of, framing that beats opening opposition and also fills a lot of the gaps of opening government. And it is growth in the West, in England, in all of these places is up right now. This for 3 structural reasons. The first is there have been a shit ton of fiscal policies done to fix this sort of thing. This is like Biden's, policies to stimulus package policies and equivalent things that have been done in the UK, which raise all of these markets up, increase growth in this sort of way. I'm uncertain how this is a tipping point on this sort of growth, since this growth is already happening. Second point, things like vaccinations are massively up, specifically in the developed world, right? COVID measures are going down in this sort of way, right? Meaning that this sort of, say, liberation of the economy, growth that will occur is likely going to happen anyways, or not right when they're saying consumer confidence is at its lowest. When COVID measures are going down, consumer confidence massively grows up. This will happen anyways in this sort of way. But thirdly, there are mega rich companies in the developed world, which, how do you say, have still had the ability to invest even on a down market, right? They have had savings in this sort of way. There are benefits to investing in a down market, like buying stocks cheap or buying real estate cheap. This sort of thing has reinvigorated the economy. And like, how do you say, this is like the factological intuition. Stocks are going up. Growth is going up in the developed world. In the developed world, this is the important thing, right? Like stocks are going up in the developed world in all these sorts of things. This means two things regarding, how do you say, opening gov and opening opposition. Firstly, when it comes to opening opposition, this means that their point about growth is outweighed. When we say growth happens anyways, growth is likely to happen anyways, so the loss of growth that we're going to get is not that significant, right? The economy has symmetrical reasons to bounce back in this sort of way, right? What this interacts with Olja is all of their points about benefiting people in England, for example, and explaining how bad inflation is in these sorts of ways, doesn't matter, because it is true that goods are more expensive, but people in England also have more money, right? Meaning that when growth is happening in the developed world, this isn't a motion about the fucking developed world, right? This is likely a motion about the places where growth isn't happening, right? In the developing world, where all of the things I said are not happening, where these countries are not rich enough to have major fiscal policy, where where people aren't massively vaccinated, therefore COVID measures aren't going down this much, and thirdly, where there aren't mega rich international corporations making investment to reinvigorate the economy in this sort of way. Meaning that the delta we need to prove the most on is in this, how do you say, in this sort of way upon the developed world. So the bottom line of what I'm doing to say is Olja's long-term arguments are out because they don't prove why we can't do them later. Their short-term arguments are out because they're all about things. Then, why is this really, really bad about the developed world? Three reasons. Firstly, the developing world now has a, how do you say, its profit when it exports to places like England decreases, right? Because notice, when you're an export economy, a low currency to the country that you're exporting to is actually very, very bad for you, right? It decreases the sort of demand for your product when they're exporting it in this sort of capacity, right? This is to say that the profit margins that they make when they export are lower when the currency is how do you call it, very cheap. So making this currency more expensive, better for the developing world. Like the reason this is a very big tipping point is right now many businesses there, how do you say, failing in this sort of way because the profit margins aren't big and all these sorts of things. We can improve these profit margins, reinvigorate economy there. Second reason is prices are high uniquely in the developing world. Notice that I said prices are high in England, but people have more money in England. This isn't true in the developing world. Many of the vital products that are imported to the developing world, things like electricity, the electricity is probably the biggest example of this, right? Things like oil, electricity, all these sorts of things that are taken from places like, how do you say, Russia and all these sorts of places, fuck them over because, how do you say, inflation being high in the developed world fucks over the developing world because products are more expensive there, but there isn't economic growth to make up that difference, which means that, how do you say, the ability of people to survive specifically there is very bad and very problematic in these sorts of ways. But before I go on opening up.
The problem with this is the same problem that Olja's developing world argument had, which is that the UK is a fairly small economy compared to the rest of the West. So what matters and the actual delta is whether the rest of the West does this. UK is pretty small.
Look, if the UK does this, firstly, the rest of the West is factologically beginning to do this, right? The US central bank is beginning to do this. But secondly, if the UK does it, everybody else will do it as well, right? For a number of reasons. The first is they want to drive investment to their bonds, not to UK bonds, which means that as soon as UK raises their, how do you call it, their interest rates, others will also want to raise it. Other developing world will also want to raise it in order to attract investment in their particular bonds. But also there's a signaling effect to this sort of thing. When UK makes a big fuss, we dealt with inflation in this sort of way, there will be pressure upon other people to do it. So factologically, other places have done this, but if the UK does it as well, then it drives a bigger change in this sort of thing, meaning that the impact is actually very, very big, right? Developing world imports a lot to, or exports a lot to the developed world. When the currencies are very, very cheap there, this is super problematic. But the third reason why this is much better for the developing world, if, how do you say, the currency is now more expensive, or how do you, rather, bonds have a higher interest rate, is it allows them an avenue for investment that is like stable Notice that many people in the developing world don't have access to things like the stock market, or there are limitations on what they can trade. When you're a state, for example, you cannot invest in things like the stock market. So having bonds that they have high interest rates and high yield allows you to invest in them, meaning that it allows you to, how do you say, get out of the crisis better, right? Because a month from now, you're going to have greater gains on this sort of investment when you've done it. It opens up investment opportunities, which generate, how do you call it, more benefits in this sort of way. I finished my speech a little early, so I'm going to talk about how weak debater Rumen Marinov is. Like 75 speeches at best. Panel, vote us.
Okay, great. I would like to thank the member of government for their speech. I would like to invite the member of opposition to deliver their speech. Here.
All right, please offer PYs exclusively in the chat. We're going to talk about three things on closing op. Firstly, why this is going to lead to a massive short-term recession in the UK economy. Secondly, impacting that, explaining why this is a horrible time to do this and how it will lead to problematic global contagion. And then finally, weighing all of our case against the structural economic issues that OG and CG identify. All clash will be integrated. Firstly, what are the actual mechanisms over why in the short term this is going to hugely harm the UK economy? The first thing to say is that when you end quantitative easing, what this effectively does is decrease the supply of money within the economy. What quantitative easing effectively is the central bank buying up assets of other banks, which increases money in the financial system because other banks who are not the central banks now have an increased quantity of money. When banks have an increased quantity of money, this then gives those banks more money that they're able to lend out into the wider economic system. That means that more, not less, businesses get money. When more businesses have money, they use that money to employ people. When more people are employed, they use the money from employment to buy food, which then funds other business. So even banks having marginally more money via quantitative easing hugely increases demand in the wider economy because a higher number of people in the economic system overall are better capitalized. The second thing to say is that a low interest rate environment makes it substantially easier for people to borrow money. More poor consumers are able to borrow money because it's cheaper to pay back that money. Like you don't need to pay the same proportion of money back to the bank and all of that stuff. It also means that a higher number of businesses are able to afford taking out loans as opposed to being locked out of that, especially for like startup businesses, when otherwise you're going to have to spend too much money on paying things back rather than investing that kind of money in other things. So when more actors within the economy end up getting money in a similar mechanism to the first point, low interest rates equals more money, which means that more actors in the economy can then spend that money on other things, whether it be housing markets or purchasing a variety of consumer goods. The third thing to say is that when there's a greater money supply, or what OG calls more inflation, this actually helps the UK economy by making it cheaper to export goods where it comes to things like cars or gas turbines or petroleums, and that closing government basically concedes as well in their argument about developing countries that that'll engage in. The important takeaway here, though, is that when it's cheaper for the UK to export other goods, this is profitable for things like UK companies. Finally, tightening monetary policy has a really negative signaling effect when it comes to markets. Whether or not the actuality of this is that the economy is going to tank or not, most investors who've been indoctrinated in the neoliberal economic system associate tighter policy with forms of contraction. And under just like Keynesian schools of economics, this is what tightening broadly means to the vast majority of people. Therefore, it's basically conceded by opening government, at the very least in the short term, you are going to get a withdrawal of things like investor capital at the point where a signaling effect is created into markets, that the government now cares more about trying to like diminish forms of growth and reduce inflation as opposed to benefiting investors to a massive extent. I want to deal with a couple responses that closing government tries to give to this. Firstly, they say that you can still use fiscal means to increase growth. There are a couple of problems with this. Firstly, if they support massive fiscal stimulus, this mitigates the vast majority of the OG case and not of their own benefits. More fiscal growth will still increase the money supply, meaning that you're still going to get currency depreciation, meaning that none of their impacts about the developing world can still apply. It means that things like bubbles aren't going to be cooled down. So more that they try and mitigate our case by saying fiscal stimulus, less of the debate there actually is, and less that they're able to get their own benefits. But secondly, we see that fiscal growth is not enough. Like what you'll probably get when you get more fiscal stimulus is Boris Johnson investing in constituencies that are really politically important for him. What we want in particular is quantitative easing, where you have more money going into banks, and those banks then do things like lend out money in more meritocratic ways and actually help sectors of the economy who need that money. The next thing that they say is that restrictions are going down. Firstly, we never know when a new variant is going to pop up, but secondly, a lot of the damage has still been done to corporations. They've lost a lot of money during the process of COVID, therefore they are a lot more weak, and we want to keep making it cheap for them to borrow money. Our second contribution then is just a massive impacting over why short-term contraction is the most important thing. I wanted to start out with some characterization here about why this is a horrible time to tighten policy. I don't think it's only COVID, as I said by opening opposition. I think the larger thing is Brexit as well. So Brexit has been hugely disruptive for the UK economy. It's harmed things like established trade systems with the EU. It's led to more labor shortages because you're getting less migration with the EU as well. And we're also seeing things like huge food shortages. So what this means that the economy is very economically vulnerable, and we would rather just bite the bullet that OG throws us and tighten later if need be. So given this context as well, what will this lead to? Firstly, a contraction is really bad for the quality of life of people in the UK, but more importantly, and secondly, this is going to lead to a contagion effect throughout global markets due to how linked entire economic systems are as a result of globalization. If citizens in the UK are poor, it actually means that it's going to be harder, not easier, for the UK to then import other goods from the developing world because the individual purchasing power of people in the UK is going to decrease. The UK banking system is incredibly interconnected to both the EU and to much of the developing world as well. When banks are more volatile because they have less money via quantitative easing, it's harder for UK banks to help prop up banks in other parts of the financial system or engage in things like credit swaps in the event of financial crisis that are occurring in other countries. Like another part of contagion is that the UK economy has a really robust financial sector. A lot of foreign companies are listed on the UK stock exchange. When UK companies end up doing worse, volatility in the stock market can have a negative signaling effect for other companies who are listed. It's things like British MNCs who are in much of the developing world who are now going to see a lot of their profits decrease as well. So we better impact like trickle down benefits and explain why that's bad. Thirdly, the short-term thing is really important because a recent trade deal was just signed between the UK and the EU. And if the economy tanks massively, this is going to be a signaling effect that like the deal failed and justify Boris Johnson pulling out. In general, this deal is economically favorable because it's leading to lower prices and a better fulfillment of comparative advantage because they're specialized sectors. Opening government.
We preempted this by explaining a short-term economic shock is easier to manage. If you do more QE during a recession, a larger money supply means the purchasing power of each individual consumer is worse. When you tighten later, you have to bail out more businesses, which means the business.
No. What you miss though is that the short-term thing is not short-term. I'm calling it short-term because it's going to happen now, but literally the entire world right now is pretty fucked because of COVID. If you literally jumpstart an economic crisis in the UK that leads to bad contagion, you're going to massively slow down the economic recovery in other countries when citizens are already struggling more economically. But finally, let's just weigh this against the structural things that other teams talk about. On their point about money only goes to large corporations when interest rates are high, panel, the reverse is true. When interest rates are small, this is when it's easier for smaller businesses to be able to afford loans to challenge larger corporations. When banks have more money, this increases rather than decreases the amount of money that they're able to lend out to other corporations. They then say things like when banks have less money, they turn to risky things like CDOs. Banks need to turn to more risky things like CDOs when they're substantially more cash strapped. Banks have less of a need to engage in risky and problematic investments when they are more financially stable as a result of quantitative easing. On their claim from CG about developing countries' imports being more expensive, a lot of developing countries also import a lot of things as well. They often import parts from Britain that they then integrate into their supply chains before then exporting those goods to other parts of the global economy. So that deals with closing government. Very proud to oppose.
All right, great. I would like to thank the member of opposition for their speech. And would like to invite the government to deliver their speech. If you're here.
Hey, am I audible?
Yep.
Okay, great. 3, 2, 1. Really firstly on like CEO's claim about how like developing countries also import, so it's not that bad with them. But no, the developing countries don't import as much because firstly, the resources that they actually like consume and produce are from within their own country, such as agriculture and natural resources. But also know that in cases with inflation, as the status quo, it is really expensive for them to import. That means that mostly those countries export, therefore our case is still in place. What I'm going to do in my speech is firstly like explain on like off bench why this policy like will not lead to really big recession, and secondly I will just weigh us with OG. But first, I'm like, would this policy mitigate econ growth? I think there are a couple of reasons that came already in my first speaker speech, but they're still really important and they didn't like rebut it. The first one about stimulus packages that came in Alec's speech is really important to clarify that we don't claim that like we'll do fiscal policies in a moment that we do this specific policy. Note that we say that they have already happened. Like Biden already printed money and gave stimulus packages. The EU did that as well. This means to a certain extent that there was an increase in consumer confidence and the ability for those consumers to actually purchase some kinds of goods and services, which means that in the status quo, the econ growth is actually really stable, especially in developing countries, to the point in which even if we do this policy, it won't mitigate econ growth as much. Secondly, there is a creation of new industries because of the pandemic. If you think about it, new industries such as like the pharmaceutical industry developed and other many new industries developed because of the shift in demand of consumers. This means that even if some kind of industries fail, there are a lot of new industry that like the government can tax still generate some kind of amounts of money. Thirdly, the pandemic itself is getting better. Note that the rest of the Europe is doing okay. Like I'm not saying like the Balkans, but probably other countries such as Germany, Austria, and other countries, which means that basically this benefits the UK, but also things such as high vaccination rates, like Omicron probably being the last really bad variant of like COVID-19, means that basically it is going to return to normal to a certain extent. And just note that this means that even if there is some kind of econ recession within those countries, like the UK, they have safety nets, which is the delta. Those countries which are developed have the safety nets to deal with it because they have a lot of money within the government. They have a lot of like expertise and analysis, which means that, but this doesn't apply to developing countries, right? Those developing countries do not have the resources to actually go out of this, but also they do not have all of the reasons that I gave about stimulus packages, about like how the pandemic is getting better. The pandemic in those countries is getting worse. Therefore, if we don't implement this policy, we are harming them disproportionately more. Before I continue, I'll take a point from opening.
Alec is right. America has already tightened their fiscal policy, and America is a much bigger economy, so the developing world's going to be fine. Your extension is out. However, I agree with your weighing against OG. That's correct, so that debate's an obsolete.
But the problem with the developing world is that those people right now in the status quo do not have the ability to export as much if like the currency is so much up. Therefore, in the moment that we like regulate it to a certain extent, it's probably better for them. But note, why do I explain this? Because all claims that, economic growth benefits people so much. But in a moment, like, I think OG fairly explains this about like how inflation is actually limiting their like abilities, capabilities to purchase new products. This means that it's kind of balanced out. But let's do the weighing. Will we like benefit people in the UK versus benefiting people in the like developing countries? Again, and it's really important, and I'm like repeating it as well, but like developed countries have safety nets. They're not doing as bad as developing world, but also on the basis of vulnerability, note that those people within developing countries do not have the ability to exercise their rights, but also in the instances in which they live, they probably lead a really shitty life, especially because of the pandemic. But secondly, they put them in this specific situation. Literally because of the UK, a lot of these developing countries are within this situation in which we on the principle right to just weigh this against weigh like developing countries over like the UK. On like the OG, what did they bring within this debate? I think like their impacts are largely reliant on decreasing inflation. And Alec told me not to say this, but the average informed voter does not know what the economy will cool off means. And they literally say this in one sentence. And I actually, like, if you think about it, the mechanism that they give is not fully explained. How specifically this will decrease inflation? Why would this be done in a good way? Why does the government has the incentive and like the bank has the incentive? And thirdly, and most importantly, like, why should we do this now? Why is it time sensitive? Which I think like our extension comes into a really great place here, because we explain the time sensitivity of this issue, because they don't explain the like difference between now and 1 year or 2 years after. This means that in a moment that we tell you that right now in the developing countries, people are suffering because of this, we should impose this policy right now in order to help them. But on secondly, note that there are a lot of contradictions within their case, and that's how I'm going to weigh this with their analysis on the developing countries, because they say, oh, but there is an increased value of the dollar. This means that like developing countries suffer from this, but know that increased value of the dollar is actually something that developing countries benefit from, because they export to the US, they export to those kinds of Western countries, which means that they gain more value from exporting. Therefore, to a certain extent, it's just factologically untrue what they're claiming. It's kind of contradicting within their case, which means that we feel a really important gap about the developing countries and like the world that benefits from this. So on the basis of weighing here, I think it's kind of similar, but stability of the econ in England and stabilizing the economy in the developing world. And I think something new here is that the importance of developing world operating as it is, because most of goods and services that are as basic as like they export are something really important circulating within the economy of the whole world. So leaving the developing world to suffer is going to catch up on us and is going to harm us disproportionately more in the long term. So that's an important way. So I have like 4 seconds left, so I'm going to say just Rumen, Marinov, better your game, like stop being the 7th best speaker in Bulgaria, become the 6th. I don't know.
All right, great. I would like to thank the government whip for your speech. And would like to invite the opposition whip to deliver their speech. Here.
Hi, I remove my consent of being recorded.